Corporate tax is a direct tax imposed on the net income or profits of corporations and other business entities by the government. It is a significant source of revenue for governments and is used to fund public services and infrastructure. Here's an overview of corporate tax and how to determine taxable income for companies. Understanding corporate tax. Corporate tax is levied on the net income or profits earned by corporations, limited liability companies, LLCs, partnerships, and other business entities. The tax rate and regulations governing corporate tax vary by country and jurisdiction, with different tax rates, deductions, credits, and compliance requirements. Components of corporate tax. Corporate tax consists of federal, state, and local taxes imposed on corporate profits. Taxable income is determined by subtracting allowable deductions, exemptions, and credits from total revenue or gross income. Calculating taxable income. Start by calculating gross income, which includes all revenue generated from sales, services, investments, and other sources. Deduct allowable business expenses, such as costs of goods sold, salaries, wages, rent, utilities, depreciation, interest payments, and other ordinary and necessary expenses incurred in the course of business operations. Claiming deductions and credits. Corporations can claim various deductions and credits to reduce taxable income and lower their corporate tax liability. Common deductions include depreciation expenses, research and development, R&D, expenses, employee benefits, charitable contributions, and business-related travel and entertainment expenses. Tax credits, such as the Research and Development Tax Credit, Work Opportunity Tax Credit, and Investment Tax Credit, provide incentives for certain activities or investments and can directly offset tax liabilities. Adjusting for non-deductible expenses. Some expenses may not be deductible for tax purposes, such as personal expenses, fines, penalties, political contributions, and certain fringe benefits. Adjust taxable income by adding back non-deductible expenses to arrive at the correct taxable income for corporate tax purposes. Calculating tax liability. Apply the applicable corporate tax rate to the taxable income to determine the corporate tax liability. Corporate tax rates may be flat or progressive, with different rates applied to different levels of taxable income. Complying with tax laws and regulations. Ensure compliance with corporate tax laws, regulations, and filing requirements imposed by the tax authorities. File corporate tax returns accurately and timely, including all required schedules, forms, and documentation. Planning for tax optimization. Engage in tax planning strategies to optimize corporate tax outcomes, minimize tax liabilities, and maximize after-tax profits. Consider tax-efficient business structures, timing of income recognition and expenses, utilization of tax credits, and strategic investments to achieve tax savings. Seeking professional advice. Given the complexity of corporate tax laws and regulations, businesses should seek professional advice from tax advisors, accountants, or tax attorneys to ensure proper tax planning, compliance, and optimization of corporate tax outcomes. By understanding the principles of corporate tax and following proper accounting procedures for determining taxable income, businesses can effectively manage their corporate tax obligations, minimize tax liabilities, and comply with regulatory requirements imposed by the tax authority.